Hey, good noon to all of our market rebels. And we've got Stu and Scotty here with us today. Welcome.
Hey.
Scotty, what's going on? Interesting day in the markets. I know when we had our Q&A this afternoon, we were slightly down, and I think we clawed and kicked our way back into positive territory.
We did. The S&P closed up just under a point, and the Nasdaq closed up looks like about just under 1.5%.
Unbelievable. What a rally. But it kind of brings us to a good topic that we know a lot of options traders are after. One of the things that attracts us to options, and that is leverage. And unfortunately, as we found, and I know both of you hear this a lot from coaching sessions, people misinterpret this whole idea of leverage when it comes to options. And what we wanted to show is that you have to understand the mechanics of how this leverage works. Otherwise, you're going to be led to bad decisions. And of course, that's never going to lead to a good outcome. So let's go find out a good question here about how much leverage do options provide. Now, before we do, let's do our little chalk talk question. So here's our question for today. The stock is 100. You buy the 90-day $100 call for $5. And the question is, do you have 20-to-1 leverage? Now, where that's coming from, a lot of traders will say, if you take the stock price of 100 divided by 5, that's 20. So they're saying, well, I'm controlling 100 shares, but only paying 1/20th the price. So therefore, my return should be 5 times as large. And so the question we want to explore today, is that true?
Something tells me it's not going to be true.
It looks true from the onset, but I have a feeling there's something inside.
Yeah, I know you guys know what that exactly.
There's always a
right.
twist, isn't there?
There's always, right. We wouldn't ask a straight up question. It's always a twist. But this is how most people see it. And if they have some kind of a lofty goal, they'll say, okay, well, I need to get 5-to-1 or 10-to-1 leverage. And they go down this path and they're calculating things wrong. Their expectations are completely wrong. So let's go find out just how much leverage do options provide.
Let me throw one thought in here for the viewers. You can imagine when you start doing the math that the lower the amount that you're paying for the option, the better your leverage looks like it's going to be. Just keep in mind that is oftentimes a driver of what option you're going to buy.
Oh, absolutely.
Which is a bad idea. A really bad idea. It just pushes you exactly in the other end of where you want to go with respect to probability of positive outcomes.
Yep. We're going to see it's a very good point. We're going to see some examples of that. So let's start off with a basic definition, what we might call classic leverage. So in the world of finance, whenever you hear the term leverage, it almost always means borrowing money. So most of you understand what's called margin trading for the brokerage world. So if you open up a broker account, let's say with Thinkorswim or with E-Trade, you can, on your application, you can sign up for margin trading. And what that does, it allows you to deposit 50% of the trade and borrow the remainder from the broker. So let's say that you buy $10,000 worth of stock. Maybe it's 100 shares trading at $100 a pop. And so you would be required to deposit half of that, or $5,000. Now, little footnote, that's actually what's called the Regulation T, or the Reg T amount, which is a Fed call. You absolutely have to deposit this. Now, when I say deposit, that doesn't necessarily mean that you go down to the branch and deposit a check. It could be money sitting in your account, but they're going to withhold that and segregate it and say that you can't touch this, withdraw it, anything until this trade is closed. So you have to cough up, let's call it, the $5,000.
That's an SEC requirement.
Yep, exactly. So now this is what's going to give you 2-to-1 leverage. And the reason is you control all $10,000 worth of the stock. You technically, in a sense, own it. You just haven't fully paid for it. So traders are saying, well, if the stock goes up 1% and I had paid full price of 100, I would make 1%. But because I paid half price, I'm going to get twice that. It's going to be 2% for me. And that's what's meant by 2-to-1 leverage. So there's this idea that if we pay for half, take 1 divided by 2, we flip it over on its head, it becomes 2 divided by 1, or 2 times leverage. So again, if the stock rises 1%, your position rises 2%. That's going to be true for margin trading. So for example, let's say that here's your $10,000 worth of stock. In the brokerage world, we call that market value long. We subtract out the debit, which is the amount that you borrowed, $5,000, and that gives us your equity. The equity you can think of as what you own, $10,000, minus what you owe, $5,000, is what's left over. So theoretically, you could sell the shares right now for $10,000, pay off your $5,000 margin debit, and you would be left with $5,000. So when you first enter the trade, your $5,000, your equity is coming fully from your Reg T amount. Now, as things change, we're going to see these numbers change. Let's say that the market value goes up 10%. So your market value long is now $11,000, assuming you haven't paid down the debit, maybe in a short run. Debit's still about $5,000. Look what happened to your equity. That $1,000 increase goes directly to your bottom line. So your equity goes from $5,000 to $6,000.
But your Reg T didn't change.
Reg T, yep, that's sunk costs once we've gone in there. Now, over time, that's going to change because you're going to pay down the margin balance. These ratios are going to change. But the point to see is that dollar for dollar goes to your top line and therefore comes directly to your bottom line. So we could shut this position down, walk away with 6,000. We started with 5. That's a 20% increase. So look at that. Stock goes up 10%. We make 2 times that, or 20%. Now, of course, we all know that leverage is a double-edged sword. So if we start off with that same position, but let's say that it falls 10% to 9,000, equity drops to 4,000. What happens now? We sunk $5,000 into the position. It's worth 4,000. We're down 20%. So it's always 2-to-1 up and 2-to-1 down.
I venture to say that this is the side that people fail to look at. Always, right? Nobody wants to think about losing the money. They only want to.
Oh, that's true too. But the side that I think everybody looks at,
topic.
Yeah, the side that everybody looks at with the options is they think this is how it works. They go, oh, I paid half the price for the option, so I've got 2-to-1, or I paid 1/4 the price of the for the option compared to the stock. I've got 4-to-1 leverage. And so again, that's the question that we want to explore. So let's go find out how this is going to work or not going to work. But first, for anybody who's brand new, please join us at marketrebellion.com/get started. Lots of great free information, articles, and videos to help you get started. So let's start things off here, guys, with at-the-money options leverage. And at-the-money option, remember, is where the strike price is really close to the current stock price.
Yeah, well, we could leave it at that.
We'll give it a little leeway there.
Yeah.
So the common idea that traders have is to divide the stock price by the options price. And they think that's the leverage you're going to get. So let's say the stock is 100 and the 90-day call is trading for $5. Now I've run all of these option prices on this screen and in future screens for this presentation through a pricing model. They were all done at roughly 25% volatility. I think it was 25.25% vol to get this to be exactly $5. But all of the option prices you're going to see in this presentation were done from these parameters. So the pricing model says this guy is worth $5. So again, what most traders would do is they'll say, okay, well, the stock is trading for 100, but I get to control 100 shares for 5. So 100 divided by 5 is 20, and therefore I have 20 to 1 leverage. So the perception is that if the stock rises 1%, the option's going to rise 20%. And if you're making your decisions based on this, you're going to be in for a rude awakening.
You're
going to be very disappointed.
Yeah. And so Billy, I know you say that leverage is a return on risk, right? Your return would be $20 while risking $1.
Yeah, you could look at it that way. Exactly. But as we're going to find out, mostly because of the deltas, that this is not going to work out, except in the very, very long run, meaning if the option goes very deep in the money. So for example,
or lack of deltas. You could actually say lack of deltas, right, Bill?
Oh yeah, well, yeah, exactly. In this case, it's more from not having the 100 deltas. So I'm going to take this information and just repost it over here as a reminder to the left. Now, again, all of these numbers are from a pricing model. So let's say that the stock we've got stock in this column, different stock prices. $100 call, these are different, put through a pricing model, again, at those same volatilities. Here's the percentage change in the stock, percentage change in the call. And then what this is the relative column, which I'll explain in a moment. So let's go through the first one. Let's say the stock rises from 100 to 105. What happens now? Well, we know that's a 5% increase. Well, what does the pricing model say happens to the call? Keeping in mind that no time has gone by. We're assuming this is an instantaneous jump. It says that it goes from 5 to about 801. That is a 60.2% increase in price. So if we have 20 to 1 leverage and the stock goes up 5%, we should be up 100%. That's what traders think. And what is it? Take 60.2 divided by 5, it's 12-fold. It's not 20-fold. So you can see that it's not even close. Now, it's not saying it's bad, but it's not 20.
It's not what you thought it was.
It's not what you thought it was, right? And so if you were setting up your goals, your strategies, everything, thinking that you were going to have this leverage, it is not going to happen, at least in the early stages. So let's try another one. Let's say the stock goes from 100 to 110. That is, of course, a 10% rise. What happens to the call? Pricing model says it goes from 5 to 1169, and that is 133.9% increase. If we take 133.9 divided by 10, we get to 1 decimal 13.4 times, but that's not 20. So if we continue this all the way up, look at this, it slowly grows. Now keep in mind, this is a 3-month option. And so even if the stock goes to 130, which would be an amazing run, kind of like your AI stocks now, it would be an amazing run. You're not even at 17 times leverage. And you thought that it was 20. Now, I ran some of the what's that?
The whole time you thought it was 20.
Whole time you thought it was 20. And so if I ran some numbers here, even at 200, you're going to be at 19 to 1.
Stock.
And if you go to $1,920, roughly speaking, would be the smallest stock price you could do.
Which is never going to happen.
Which is never going to happen. I'm just making a point that at that time, you now hit 20.
I should never say never. I feel compelled to take 30 seconds here and do a little sidebar on a topic.
Sure, go for it.
I'm going to do it anyway. So take a look at the top 2 lines here, 100 to 105. That's a 5-point swing. We all know that the at-the-money call has a 50 delta. 50 deltas on a 5-point swing is $2.50, and we go from 5 to 8. Now, if there's anybody out there that's kind of wondering, like, what happened to the 51 cents, I suggest that you batter down in your bookwork a little bit and try and figure that out before you hit another send button, because that is super important.
Absolutely true. But we're going to find out that's really what's causing this discrepancy right here.
Another topic for another day, but things are not looking quite consistent if you don't really know about the product, and you have to know about the product if you're going to trade the product successfully over the long term.
Yep. But since you brought it up, let's talk about that. The delta would be roughly 50 for an at the money, but of course we're not at the money with the stock at 105 anymore. We've got some gamma, but let's just say it's roughly 50. And so instead of being 20, it should be closer to 10. And that's what's happening. We're really only controlling 50 shares at this moment, even though we technically control 100, right?
Yeah, and that 50 is changing on the way up.
That's right. And that's why it's actually a little bit more than 10 right here. That's from gamma, but exactly right.
Mm-hmm.
So let's try another one. Let's go to deep in the money. Now, we've talked about this before. I know you teach it, Stu. We talk about it all the time in Q&A for stock replacement. This is a specialized type of trade where it's still a long call, but you're just going super, super deep in the money, usually to about a delta of 85 maybe. Yep. And that's going to make it behave almost like shares of stock. Unfortunately, everybody backs away because they think it's a really expensive option, and it's just not. It's a relatively cheap option. But let's see how the leverage pans out here. Let's put our stock back at 100. Same 90-day expiration, but we've got an 80 strike. Now, again, using those same parameters, again, I think it was about a 25% vol. Pricing model says this option is worth $20.17. $20 of intrinsic, which has nothing to do with the option, 17 cents for the right to walk away.
That's all it called for? It was 17 cents over?
That's all it called for.
Now, who here thinks that's an expensive option? Not me, right? That's a 17-cent option.
It's a 17-cent option.
Who's not buying that if they want to buy the stock?
Exactly. But the problem is I'll say, okay, well, it's roughly 5-to-1 leverage because the stock is 100. We divide it by 20.17. We get 4.96, close enough to say 5. But let's just stick with the actual numbers. It would be 4.96 to 1 leverage. Now, the question is, are we going to see this? Are we going to be closer to 4.96 or further away compared to the at the money? And the thing that you want to look at, as Stu kind of brought up, is the deltas have got to be really high here. Because another way we can figure this out, we could take the $80 strike plus the 20.17 option premium, we'd get 100.17, which is just 17 cents above the stock.
Right. So it's like a 98.
It's got to be, it's right. It's going to be well into the 90s. This is basically stock. So if our theory is right, that it's more about the deltas, we should stay pretty close to 4.96. So what do you think is going to happen here, guys?
I'm thinking it's going to be pretty close. It won't be exactly, but it'll be close.
Yeah, that's exactly right. So
let's go closer than the at the money.
Oh, yes, exactly right. So let's go do the same thing. Here's this information over on the left. So if the stock goes from 100 to 105, that's a 5% increase. The $80 call goes from 2017 to 2506. Look at that, picked up almost the full $5.
Mm-hmm.
It's a 24.3% increase. We take 24.3 divided by 5, we get 4.85. Not too far off of 496. As the stock continues higher, stock goes from 100 to 110. That's a 10% increase in the stock, 48.9% increase in the option. That's going from 2017 to 3002. Divide those out, we get 4.89. So now if we work our way up here, continually letting that stock price rise, you can see that they're fairly stable. And
so here's what's catching my eye in this. I'm at the 120 line. I see that the call is $40. I know that's parity.
That's parity, yep.
And that's 100 delta, yet it's still not the 4.96 number.
Exactly.
Now I'm kind of thinking like, well, where did it go, right? So we had to make up for the delta that we didn't have.
That's very good.
That's what kind of gets in the way here and creates this noise.
That's exactly right. Very good. Yeah, but we are at parity here. And if we keep chugging it along, I just picked an arbitrary point, stock of 200 stock price. We're at 4.95. And then I tried to find the in round numbers here, the lowest stock price where we would actually get 4.96. That was a stock price of 360, but much better than the at the money. The at the money was just way, way, way up there before you were going to see the, in that example, 20 to 1 leverage. But the thing is, you see how this is fairly stable. So if leverage is really part of what you're after for your strategies, and you really want, in this example, let's call it roughly 5 to 1 leverage throughout, not because the stock price has gone up $50, you want it at all stages. You really need to be deep in the money, or those numbers are going to be vastly off. Now, what do you think is going to happen?
Which kind of explains why you got to have a high delta for a stock replacement call.
Because you're not making it mimic stock.
Exactly. Whys, the whys of that happening. Yeah, that's cool.
Right. So now we've kind of tapped into the theory behind it, the mechanics. What do you think is going to happen if we go to out of the money options? Now, most people think out of the money options, because they're so cheap, they get tremendous leverage here. But what do you think is going to happen now? Going to be closer compared to in the money, deep in the money, or further away? How do you think these are going to behave?
Definitely further away from the original assumption. The original assumption makes the assumption that the option moves $1.
Very good. Yep. So these are going to be way off track. Now, again, we're not saying that out of the money options are bad or anything like that. We're just trying to help you to understand that you can't take the stock price divided by the options price and say that's how much leverage you have. So let's do it again. Let's put the stock at 100, 90-day, $110 call. Pricing model says it's worth $1.69. We take the stock price divided by $1.69. We get a whopping 59.2 times leverage. So traders would say I'm getting 59.2 to 1, or roughly 60 to 1. Is that true? Well, let's go find out. Stock goes from 100 to 105. That's a 5% increase. Call goes from $1.69 to 324. That's 91.3. We divide those out. It's 18%. It's 18 times the amount of the percent return that you did here. Stock goes to 110. That's a 10% increase for the stock, 225 roughly for the option, 22.5. But look at how slow that climb is. 30, 34. Stock price of 130. You're at 37 times leverage, not 59. You go to a stock price of 200, you're at 55. Getting closer, but still not 59. The lowest stock price I could put in to get it to be 59 was 10,000. So are you going to see 59 while you're holding this 90-day option, probably from 100 to 105 or 110, especially if you're a short-term trader? Not even close, not even remotely close. And that's because of delta and gamma. So any comments here about the out of the monies? Because I know a lot of traders like this because they talk about the leverage. And usually the leverage is because they buy more contracts. And that's a separate story. We could do that for a different day. So if you're comparing 100 shares of stock to one out of the money option, you're not going to be close.
Yeah, you can definitely try and make up for this.
By buying 5 contracts or 10 contracts. Right?
Yeah, and like you said, Bill, that is definitely another topic for another day. But that's part of the whole leverage game to lever the money that you're really not using to buy the stock in an effort to gain additional exposure. Right, just be aware of what you have, and also be aware of what I alluded to earlier, which was. As you go farther out of the money to get what you think is going to be that better leverage money, you're going to get less of a performance via lower delta.
Yep. And I'm not going to mention names, but there was a service. This was years ago, back for those of you who remember Ron. We were at a convention, and there was the service that they were promoting. I think it was $5,000 down. Open up an account with them. They were going to give you they had the crystal ball, and they were going to turn it into 100,000 by the end of the quarter in 3 months.
I'm in.
And so needless to say, they have since folded. But part of my point is one of the things they would do is they would back into what rate of return would you need for that to come true. And then they would calculate the leverage based on this. And we're sitting here looking at it going, even if they call the shots right, they're going to fall way short. Because they don't have the leverage that they think. So that's kind of a good example where traders can maybe have some good calls, be in a really good market, and still fall short of their goals because they're not understanding the way that the leverage works for the options.
It really could amount to just an inefficient use of capital. At the end of the day.
Yes. Yep. Very good. So let's take a look at a different way to calculate it. And before we do, please check us out, marketrebellion.com/get started. I can't emphasize enough how important it is to get good information. Really easy to find bad information out there. There are some good sources, but how do you know what's good and bad if you're brand new? So just make sure you get a good solid footing before you get started and develop bad habits. So marketrebellion.com/get started.
Well, that's why you should listen to us, right? Don't you think everybody should listen to what you tell them to do? No, I do. How about you, Scotty? I mean,
we
absolutely
try to give them the best.
Yeah.
So let's take a look at this graphically. So if you remember the deep in the money, that was the 80 strike. I think it was $20.17.
Yeah.
We calculated 4.96 to 1 leverage. Look at how flat that line is. This is going from a stock price of 100 all the way up to 210. Now, again, we're not moving time. We're keeping the time at 90 days, but look at how flat that line is. Again, pretty stable. Now, if we go to the at the money, we calculated it to be 20 to 1. It was a $100 stock and a $5 option.
Yeah.
But look at this. Stock's at 100. I mean, where are you getting close to 20 to 1? Even out here with a stock price at 210, you're still not even touching 20. So if you plan to hold this for, let's say, a very short term, benefit of the doubt, let's say you're going to hold it till it gets to 110, you're at 15 at best. And that's assuming no time has gone by. I mean, so you can see that the leverage is going to be very different from the way that you think it works if you're simply taking the stock price divided by the options price. Now, what do you suppose the out of the money graph looks like?
Even worse.
Even worse. Yeah, that looks like that. So again, moving from a stock price of 100 up to 210, you're going to start out at about 15 to 1 leverage.
And here's something that everybody, I think, should think about. Look, I know what it's going to look like. Scotty knows what it looks like. Bill obviously knows what it looks like. He drew it. Do we expect you people to, the viewers to know what it looks like? Well, we would like you to have an idea what it looks like. Do you have to get it exactly? No, we're not going to get it exactly.
No.
But get in the game. Just have an idea of how this works. What's the graph? What's the P&L going to look like if you do some strategy? This is across the board. This is all over the place. Just kind of what it's going to look like in the future as you make different assumptions about stock price, time, and applied volatility, and even interest rates these days.
Yep. So even if you just are aware of this problem, then you can have the tools, which will show you a better way to do this in just a moment, for calculating it. And you can at least know that it's not as simple as taking the stock price divided by the options price, which is what a lot of people teach. You're going to fall way short if you need that leverage. So take a look here, even with a stock price of 130, you're at about what, 35 maybe, 37?
Yeah.
I mean, that's far cry from if you need 59 to reach your goal. Even up here with a stock price of about 180, maybe 175, looks like we're finally breaking the 50 barrier. But remember, that means the stock's got to get to 175 when it's still a 90-day option. I mean, it's just not going to happen. So the chances are you're going to be more in this range.
I got to hang in there because I'm not getting my money that I think I should be getting.
Right.
Then, that might force you to stay in the trade longer than you actually should. And, look,
good point.
What's the probability of this thing's going from 100 to 200 or 100 to 180 in that short period of time?
Pretty close to zero.
Next to nothing. Yeah. So
that percent change can be negative. Could decrease in a negative manner very quickly.
Yeah, which remember, if it dips below here, then we're going to hit minus 100% at expiration for even though the stock might be 0% change. Just to keep it easy to make the point, I wanted to just stay on the positive side here. But it looks quite different on the left-hand side too. So now, what can we do? Is there a better way to get a gauge on how your option's going to behave? And the answer is, yes, there is. And this is one that we use a lot called elasticity. It's required for doing beta-weighted portfolios with options. So what's elasticity? Elasticity, we take the stock price times the delta of the option, divided by the option's price. And when you do this, the percentage changes will be equal, assuming we're talking about a small range. So let's go back to our $100 call trading for 5. Remember, this is from a pricing model. And that same pricing model says the delta is 0.525. We take the $100 stock price times the delta, we get 52.5. We take 52.5 divided by the options price, we get 10.5. And that tells us that we should get about 10.5 times the percentage change for the stock over a small range. So let's say the stock rises to 101. That's a 1% move. The option should rise about 10.5%. We put it into a pricing model. It's worth 554 and it's 10.8. So the reason it's not coming out exact is because of what's happening there, Stu. What's that?
So you got your gamma.
Exactly. It's accelerating those deltas and it's changing the calculations. If we did this over, let's say, a 0.25% move, it'd probably be really close. But that can at least give you a better idea of what to expect in the short run. As opposed to, we said it was 20-1. Now, why are we getting 10-1 here, roughly? Because the delta is roughly a half.
Yeah, Bill, when I think of elasticity, it takes me back to my economics classes.
Oh, yeah. Yeah.
But I think what this is saying is this elasticity is just a calculation showing how one asset changes relative to another asset. And the 52 delta multiplied by the 100 shares of stock then puts the change of the option in terms of the stock.
Very good. And you are exactly right. It is one that's mostly used in economics. They usually talk about elasticities of supply and demand curves, which is the percentage change in quantity divided by the percentage change in P, or the price. And that's why they do it. They can say, well, if prices move, what can we expect to happen? But that's where a lot of this is, that's where these calculations are coming from. It's the same idea.
Yeah. So as the option price changes, as reflected by the delta, multiplied by the underlying 100 shares of stock, you get an equivalent change to the option price.
Very good. That's exactly what it's doing. It's just putting them on a kind of a balanced scale, comparing apples to apples. So again, kind of the rough way is if you just took 100 divided by 5 and said it was 20, well, we need to really scale that by the delta. So in your head, you know, an at the money is roughly a half. So you can say it's going to be somewhere, instead of 20, guess 10. It's going to get you much closer than thinking you're going to get 20. All right, so that's a little calculation you can do. Now, here's the in the money. Same information. That was the option price we saw, 2017. The delta, 96.7. We take the stock, 100 times 0.967, we get 96.70. Elasticity is 96.70 divided by the options price, or about 4.8. We bump up the stock's price by 1%. And the pricing model says that option goes from 2017 to 2114, which is a 4.8% increase. Look at that, spot on. What about the out of the money?
Look at the change in, this is the trader in me. Look at the change in call price, 2017 to 2114.
Oh, yeah.
What's that, 97 cents? Well, take a look at the delta. Whoa.
Yeah. No shocker there.
Yeah.
Right. And the reason it's very close to 97 is because
what an option is going to be when the stock does something, instead of waiting for the market to tell you what it's going to be. Take a look at this.
Yeah. And that's because we have almost no gamma.
A lot of hidden gems in this presentation.
Oh, yeah. Yep. Traders pick those up. So let's take a look at the out of the money. So remember, the 110 call was $1.69. Now that delta was 0.243, roughly a quarter. So we take the stock price times a quarter, comes up to 24.30. Elasticity is 24.30 divided by the $1.69 option price. We get 14.4. Stock rises $1 or 1%, again, a small range. And the pricing model says that call goes from $1.69 to $1.95, or 15.4%. But it's at least close. Now, what's throwing us is that technically a 1% increase is really too big. But it's not bad for practical purposes. At least you're not going to go, oh, I've got 59-1 or 60-1. You can look at this and say, I'd plan more on about 15-1. 14-1. Okay, for at least over the short run. And then what can you do on the next time? If you wanted to know, you're going to get a new delta, new stock price. Do the calculation again. You can kind of walk it along and see what it is, dollar to dollar, instead of trying to say I'm always going to get 60% or 60x. Yeah.
There's so many lessons here. I mean, it just goes on forever. You know, like, you think to yourself, what Do I have the same risk profile at 100 versus 101? Or how about if it goes to 105? Or how about if it goes to 110? There's the people that answer no to that are the ones that are just kind of hanging on and hanging on and hanging on, and then watch their profits disappear when the stock turns around and goes away. Didn't take any mitigating factors to roll out of some of that risk.
Yeah, absolutely true. So, Scotty, any comments on this slide here?
Well, I was going to say, I think when you're new to options, there's a common tendency to gravitate to cheaper prices.
Absolutely.
And those cheaper prices are not always
what they're cracked up to be.
What you're going to get. There's a lot of other factors involved. And to just take the option price and divide it into the stock price is not the appropriate way to measure the leverage. And also not an appropriate way to understand how that option will change over time relative to volatility. And
absolutely. Great point. Absolutely. Absolutely. All that has
to be.
That's
kind of what we wanted to show people here. Now, again, completely separate topic. Mathematically, we can show that an out-of-the-money option, you are mathematically borrowing more than 100% of the stock's price. And in fact, it's almost giving you enough to go in and buy the insurance policy on top of it. So they do provide a lot of leverage. And where most traders get that from is, in these cases, we've compared 100 shares of stock to one call. But what a lot of traders will do is say, okay, instead of spending $10,000 on the stock, let me spend $3,000 on these out of the money calls, and now they're controlling 800 shares or 1,000 shares. And that's going to greatly change these calculations. That's a whole separate conversation. But right now, we just want people to know that this methodology that you hear a lot about out there, especially on YouTube, of taking the stock divided by the options price, and that gives you the leverage, is absolutely false. So what do we want to take from this, guys? One thing I know for me, which we've talked about many times before, the importance of a goal. Do you need that much leverage? How much do you need? Why do you need it? And if you do, you need to know how to calculate it, which means you need to understand how options work.
You say this
all the Greeks.
You can't do any of this without a goal. You got to have a goal.
Yeah. Yep. So that's always one of our underlying themes here for Coach's Corners, to show people finer points of trading. We've got two of the best world-class coaches here. I know Stu was I keep having to ask you, it was 29 years at the Philly floor, right? As a market maker and specialist. It's unbelievable, considering that I think it's 98% burnout in 6 months.
Oh, it's a big revolving door in any of the exchanges. It was a giant.
Yeah. So for people who think that the market maker is the easy job and they just manipulate prices, is sadly mistaken. It's a very difficult job. But my point is that we try to show people why it's not as easy as everybody else makes it out to be. So if you're not getting the results that you think you should be getting, this is probably where to start looking. It's probably because you don't understand options the way that you think they work. So closing comments, anything, Scotty?
Oh, that was great, Bill. I would just say that it is really important to understand some of the finer details in option trading. And the more you do, I think the better you will position yourself, and the better you can create a strategy that fits the market environment, stock you're trading, and your own personal risk tolerance. Well said. Stu?
Feeding off of that, what Scotty said, and when he said in this market, I hear that a lot. This market. Well, that doesn't mean anything. You as a trader have to adapt to the market conditions.
Correct.
You can't just chug along and do what you did 10 years ago or last month. Markets change, prices change, interest rates change. Options are options, but you got to go with the flow, and you have to understand where the risks, where the holes are. Ask yourself, how can I lose? Where's the hole in this strategy? And don't blame it on the market.
Right.
Just blame it on yourself. Take accountability. Blame it on your inability to see the bigger picture, and then go do something about it and learn about the product, and then go and trade it. Right? Don't try and trade it before you know about it. Learn about it and then go and trade it. I know people that practice this for a year, 2 years, 3 years sometimes. And those are the people that will create longevity for themselves. in the marketplace, because they learn the market. They do their very best not to learn the hard way, like we had to do, like I had to do.
Absolutely true. So just remember that in order to make the best decisions, you need to know how options work and how markets work.
Yeah.
And if you don't, you're going to be led to many myths and misperceptions that are so prevalent out there in the markets. And if you're making what you think are the right decisions because of the right market conditions, but they're done for the wrong reasons, you're never going to have good outcomes.
Yeah, it's only going to be, you might get lucky, but it's only going to be a matter of time.
And unfortunately, sometimes that can actually be a detriment because now you think you got it figured out when it was nothing but luck.
Yeah, and it's just a matter of time before you give it back, and then you're under, and then you're chasing the profit, and it's just a mess.
It's just a mess. So for anybody who might be interested, check us out at Market Rebellion, and you can even hook yourself up with some coaching sessions with Stu or Scott. And we will look for you next Thursday. We've got another really cool topic for you, and we'll see you then on Coach's Corner.
Take care.
Have a good afternoon, everyone.